Okay, we are at 8 o'clock now. I'm Alvin. So today's webinar is on this book review. So it's the first time we are doing a book review on the webinar. And I think that it's worthwhile to share about this book because it can help us understand investing a lot better. And few people are very cognizant about this factor-based investing. So I want to share about what I learned from this book as well as what I think it could be improved, and overall whether you should read it at all. All right. So that's the purpose of this webinar. And there's a question box which along the way, if you have questions, you can text them in. But I'll only address them after my presentation, which should take about half an hour. So we can leave about 15 minutes for the Q&A. Okay. Just to introduce myself, because some of you may not know me and it's first time hearing me speak. I'm the founder and CEO of Dr. Wealth, and previously we run a company called Big Fat Purse. All right, so it's still the same team. We still have the same mission, which I'll share about later. So I have written books on the secrets of Singapore Trading Gurus and Singapore Permanent Portfolio. All right, they are all available in the major bookstores, which you can purchase them. I'm also the creator and trainer of our flagship course, the Value Investing and the Dividend Investing Mastery courses. Okay, I also do quite regular public speaking in various settings and occasions. And our company mission is to help people who wants to do DIY investment to help you invest better. Okay, we believe that at the end of the day, you have to understand that you care about your money more than anybody else, right? Because it's your money, and it makes sense that we have at least a know-how to learn how to manage our money better, and we want to provide that kind of education and tools to help you do so. So first of all, right, what is factor-based investing? This is a pretty new term, and it originated from the academic world, but there are very useful real-life application that we can tap on this research. Okay, so this whole book is about explaining this factor-based investing concept to you, and what it's wonderful is that it's able to do it in a very layman manner, because as you know, research papers are very tough to understand, very the words that they use, a lot of jargons, a lot of mathematical formulas, and they're quite difficult to read for laymen. So this book does that justice for you. So even if you don't want to read the research paper, you can always refer to this book, which pretty much cover the essence of the developments in factor-based investing for the last 20, 30 years. So what is factor-based investing, right? So imagine this. There are investing gurus like Warren Buffett, George Soros, etc., etc. So each of them has like their own secret sauce to help them make extra excess investment returns over the years. And what they found out that is, what if I can break down this secret sauce into a few metrics, in a few factors that will give you the same performance as these investment gurus. So that set out how the academic community went to search for this secret sauce, okay? And eventually they were able to break down these various gurus, whether they have alpha, no alpha, and whether certain exposure to this particular factor was how the stocks were being selected, for example, okay? So essentially, this factor-based investing is simplified way of replicating so those investors, those renowned superstar investors, how they actually invest. Okay, what metrics actually matters. And it started, I would say, in 1993, which was made famous by Eugene Fama and Kenneth French. So Eugene Fama is a Nobel laureate prize winner, okay, and they were the two that found out that, hey, you know, things like value investing strategy do have excess returns, and they are able to show it with math using empirical evidence, where they dig through the stock prices in the past and certain metrics and show that, hey, yes, indeed, if you buy value stocks, if you buy small cap stocks, you actually do better than the market returns as a whole. All right, so that sets out the entire factor-based investing movement. And why they did even look at value in the first place was probably due to the successes of Benjamin Graham and his disciples that were able to deliver astounding results over the past 70, 80 years. That pique their interest and say, hey, why don't we just test whether this strategy really makes excess returns? And the academic community actually found that it is true. So value investing does have excess returns. The book, what it does well is it talks about at least 5 factors in terms of stocks. Okay, there are 5 factors that give you excess returns, and the factors do not only apply to stocks. There are factors that applies to bonds as well that give you excess returns. I will not cover these 2 terms in this webinar itself. So if you're interested, you can always read more about the bonds. I'll touch more on the stocks because that was where the factor-based investing was started and began. So it's a lot more established. There's a lot more research on stocks factors rather than bonds factors. So over time, you'll see there are more factors that will be derived in the other asset classes, and it takes some time to mature. So we'll touch on only the stocks, which are pretty much quite mature at this point in time, where there's a lot more practical applications that we can use. So in order for a metric to become a factor, right, or a group of metrics to become a factor, it must fulfill 5 criteria. So this is what the academic community used, and Suidro and Birkin did well to explain these 5 reasons. So first is that it must be persistent, which means a factor must work over long periods of time. It cannot be it worked for 5 years and then it doesn't work for another 50 years. Okay, so it must work for long periods of time, 50 years, 60 years, 70 years. Okay, so it must be persistent. And the second criteria is that it must be pervasive. That means it cannot just apply in the US. It must apply in Europe. It must apply in Asia and all around the world, and different regions and different sectors. All right, so it must be pervasive. And the third criteria is that it must be robust. So for example, a value factor, right, may have different definitions, like it is low price to book, or it can be low price to earnings. So the concept of value can be expressed in different kind of metrics or different kind of definitions, and then it will be considered a factor because it is robust. And number 4 is that it must be investable, because if it's just a theoretical academic pursuit, right, and it's not replicable in real life, then it defeats the purpose. So it must be investable. And lastly, it must be intuitive. Because there is always a backlash on all this quantitative research, because many people start to label them as you are just data mining. Over time, you'll be able to find something that, yeah, indeed, particular phenomenon will generate excess returns just purely based on data mining itself. So number 5 tends to want to remove this data mining issue by saying that it must be able to explain why it worked. Okay, so in terms of the explanation, if you read throughout the book, there are 2 schools of thoughts to explain things. One is the risk-based theories, which says that if in order for you to get excess returns, you must take excess risk. Okay, you must take additional risk. So for example, buying value stocks, they are actually taking more risk because they feel that these stocks generally are weaker than their counterparts, and that's why they are priced lower. And by investing in them, you tend to take higher risk. So that's a risk-based theories. And the other side of the explanations are more behavioral finance in nature. So they are saying that because we cannot expect that every investor is rational in their decision-making process when they invest, so they make mistakes. They make cognitive mistakes because of biases and etc. So for example, I talk about small cap stocks that have high returns, likely because most investors do not like to invest in small cap stocks, which they think that they are not stable, and big cap stocks are a lot more safer. So there is a certain bias for big cap stocks, and that is why there's a price discrepancy due to the difference in the ununiform distribution of capital more towards the big cap stocks. Okay, so it depends on how or which frame of explanation do you believe in, whether is it risk-based or behavioral finance based. So it should have a reason why this particular factor is working out. Okay, so a factor can only be qualified as a factor when they have all these 5 characteristics as mentioned here. Right, so all the factors that has been mentioned in this book has passed all these 5 criteria. And this is how the structure of the book is shown. So Sudra and Birkin went through the 5 factors in the stocks, and in each factor they will go through the 5 criteria. So they run through whether to discuss how persistent they are, how pervasive they are, robust they are, investable and intuitive they are. Okay. And they do it likewise for the bonds, and as well as there are a lot of appendices that talk about other things such as dividend, whether is it a factor or not, which we'll cover in the later part of this webinar, as well as the low volatility factor as well. So it wasn't in the main part of the book, and it was put in the appendices. Okay, so this is where I'll share what I like and what I dislike. And I think because if you structure the book by factors, it's a lot easier to refer. So especially if, let's say, you want to find out a particular factor first, for example, you want to find out momentum first, you can just flip to that side. So it's a lot more structured in that sense. And it's simple to understand because a lot of jargons and concepts are used minimally. They still exist, but they are minimal. Okay, over time you should be able to get familiar with them. And what I dislike is that, in fact, half of the book are in appendices. So it seems like the probably it looks more like a draft than a proper book, because you don't expect appendices to be covering majority of the book itself. Okay, so half is a bit excessive in my opinion. I thought some of the appendices could have been covered in the main part of the book rather than being put in the excess pages at the end. So we touch on the following the structure. So we touch on the market beta. Okay, so let's explain what market beta is. Assume your portfolio beta is 1.5. All right, your beta is 1.5. Okay, so for example, if the general market goes up 10%, your portfolio is up 15%. So beta is a measurement on how correlated you are with the market returns. Okay, so if you're 1.5 times, means you'll be moving 1.5 times either up or down according to the market. So if, for example, if the market goes down by 20%, your portfolio should be down by 30%. So that is the definition of beta itself. All right, but beta is just a rough measure, because beta can always be, it's quite dynamic, it changes. So your portfolio beta is not always a fixed number. And what is useful is that you have always heard this, right? If you buy stocks over the long run, right, should have higher returns than bonds. Okay, so this market beta is trying to explain if you invest in stock market versus if you invest in, say, bonds, and because the two authors are based in US and most of the research are done in US market, and that's why they compare the US stock market with the US Treasury bill, which is like a form of bond, a short-term bond. All right, so if you invest in the US stock market for the past 70 years, about that, based on their research time frame, and versus you invest in US Treasury bill for the same period, the portfolio with the stocks will be higher than the returns from the Treasury bill by 8.3% per year. Okay, so that's a very substantial returns if you invest in stocks. So that's why it's a lot more lucrative. But they also give the caveat and says that, but there's no free lunch in investing. So if you invest in stock market, there's up and down, right? Whereas when you invest in a treasury bill, it's always up, it doesn't come down, and your base is always your par value or face value is always there, right? It's anchored, so you won't have any volatility being experienced. So what they did was, one of the emphasis for the authors were, they put out a probability of outperformance table, as you can see here. Okay, so what it's trying to say that if you hold a pure US stock portfolio, right, you in 1 year you have a 66% chance of beating bonds. Okay, so you still have a good 34% that you may not beat bonds and get lower than bond returns. And 3-year, 5-year, 10-year, 20-year, as you see, as they extrapolate out into a longer period of time, you can see that the chances of stocks beating bonds have increased. That means that being a long-term investor in stocks will give you a higher chance of doing much better than if you have invested in something that you feel safe, and there's a lot higher chance that you get higher returns. All right, and this is a good basis. But you can see that some people don't like it, right? Imagine I hold a stock portfolio for 5 years, I still have a 18% chance of not beating the bonds, and that feeling really sucks, because people will have expected, hey, 2 or 3 years I should have a higher rate of return than I would have put in bonds. So that um, tells you that there's no free lunch in investing, and that is the risk of underperformance that you have to experience when you invest in stocks. All right, so which means that periods of underperformance would force an investor to give out on stock very easily, and this is a very true, because based on our experience when we interact with investors, it is definitely a reflection of the real life, because we always hear investor when they hold a stock portfolio for 2 years and they don't see any much returns, then they would have, let's say from the bonds market or even CPF returns, okay, they will feel very upset. They'll feel that, hey, this stock investing doesn't work at all. Okay, but actually 2 years is just a drop in the ocean, and in the long run, as you can see, the odds of beating the bonds returns is a lot higher when you invest in the stock market. So how do you capture market beta, right? So that brings us to the broad market index ETFs. So major indices like S&P 500, you can just buy the exchange traded fund. You can buy the Vanguard Total World Stock. You can buy the STI. If you have exposure to Singapore market, you can also buy KLCI ETF in Malaysia. So these are some of the examples that how you can actually capture market beta. So you may not just want to buy bonds. Having some exposure to stock market on the long run should help you do better than you would have with just bonds. Let's move on to size, okay, the second factor. And how they define size was that you rank the whole US stock market by market cap. So from the biggest market cap to the smallest. So you divide them by 2. So you have a bottom half and a top half. So the bottom half are the smaller ones and the top half are the bigger ones. All right. So bottom half are known as small cap stocks. Top half they label as the big cap stocks. Okay. So the statistics show that small cap beat big cap stocks over the long run. Okay, and the difference in returns is 3.3% per year. So which means if you have a portfolio that invests in small cap stocks and you have a portfolio of investing in big cap stocks, the small cap portfolio will have an additional 3.3% more than the big cap stock. So if big cap stock return 10% per year, the small cap stocks will return 13.3% per year. Okay, so that's how you can read this performance chart. Right, so the data is from 1927 to 2015, right? So that's close to 90 years. Yeah, close to 9 years of data. So what I learned about size is that it's better to combine with other factors such as value, profitability, or investments, and rather than a standalone factor by itself, because it tends to enhance the returns of other factors than giving the excess returns more reliability over time. All right, so that was something I picked up from the book. And let's move on to value. So value, how we define it is, or no, how the authors define it is that they divided the US stock market by book to market. Okay, so probably this requires a little bit of explanation. What do you mean by book to market? Okay, so most of us understand that usually one of the value metric is price to book ratio. Okay, price to book ratio. All right, so this book to market is actually the inverse. Okay, so you have the book on top, okay, which means book value divided by market. Actually, this market is divided by market cap. Okay, so this price is stock price, which is related to market cap, right? If you multiply by the number of shares. So price to book also, this book is book value per share. Okay, so this book here refers to the book value as a whole. So you take the book value of the company, you divide the market cap is the inverse of price to book ratio. Okay, so they are equivalent in the inverse sense. Okay, so book to market for undervalued stocks. Okay, so that's how they define it. You have a top 30% of the stocks that's ranked by book to market versus the bottom 30%. So this top 30% will be known as the undervalued stock. Okay, so this top 30% will know as undervalued stocks, because if your book value is a lot higher than the market price, okay, it means that you're undervalued because the price is much lower than the book. Okay, so that's how you can read it. I know sometimes when it's inverse, it's a bit difficult to understand. Okay, so the difference is if you buy a basket of undervalued stocks versus a basket of growth stock. Okay, so the reverse of undervalued stocks, they label it as growth stocks. The difference is 4.8% per year. Okay, so if you are always buying low book to market or high price to book stocks, right, you are actually doing yourself some disservice because you are actually getting lower returns. Okay. So what I learned about value, and this is something extra that I picked up, okay, because myself and some of us are value investors, so we are quite familiar with this value concept. So one thing that I picked up myself is that about the robustness of the metric itself, factor itself, because it can express value into these metrics. Okay, book to market is the one that we discovered just now. So you can use earnings to price, cash flow to price, whichever works, right? There's just a different way of expressing value, okay? And don't be too concerned about, oh, wow, I think that I should use cash flow to price because it give me higher returns. This is market dependent, depending on what cycle you are in. We cannot determine that, say that, oh, one metric is better than the other. Okay, it's just a general sense that they all work because they are exposures to value in a different way. But that it doesn't tell us that, oh, this return over this metric is better than the other. So don't get the wrong message, because for all you know, different market cycle, book to market might do better than cash flow to price. Okay, so it depends. So we don't want to over optimize certain things at this point in time. Next, we talk about momentum. Okay, so how the authors define momentum was by the 12-month returns. Okay, excluding the latest month. All right, why excluding the latest month is because researchers found that there tend to be some reversal on a month-by-month basis. So you don't want the momentum to be affected when there's some correction in the latest month. So they excluded the latest month. They only measure the last 12 months, excluding the latest month. Okay, so that's how they define a stock with momentum. Okay, so basically very price based. They want to buy stocks that went up and not short the stocks when they go down. Okay, so their top 30% and bottom 30% by their 12-month returns. The top 30% will be the up momentum stock, and the bottom 30% will be the down momentum stocks. Okay, so you want to compare the difference. So if you long both portfolio, right? Okay, that's what happened. So if you long the up momentum stocks and you long the down momentum stock in the same period, each year the up momentum stock portfolio will give you 9.6% per year. Okay, so this is a bit counterintuitive from the value stocks that we talk about, because value usually you buy low and sell high, right? Whereas momentum, you are buying the highest price stock for that year. Okay, and that generated an outsized 9.6% per year returns. Okay, so momentum, if you really discovered throughout the book, right, it gives you the highest performance gap compared to the other factors that we talked about today. But momentum is not a free lunch again. I learned a lot more about momentum from this book as compared to value and size. Okay, so two things that I learned, two types that I learned about momentum is that the first type is called a cross-sectional momentum, which means you are actually comparing to the same asset class, right? Other kind of stocks that is being ranked in that space, and you identify the top 30% and bottom 30%, which we have just done so. Okay, so the slide that we see just now, this slide, all right, is known as the cross-sectional trend momentum factor. Okay, there's a comparison, there's a relative ranking. Whereas for time series momentum, it is absolute. So for example, you just need to compare this stock A, for example, the price now and the price 12 months ago. I know whether this is up or down. Okay, if it's up, I long. If it's down, I short. All right, so that is more absolute. I don't need to know whether stock B, how stock B is doing, stock C is doing. So it's just by itself, I can tell what's the trend. So most of the traders that you heard of, or the trading strategy called trend following, is usually a time series based momentum. Okay, so either way it works. All right, so but they just want to explain it in more detail about this momentum. And as I said, this is the best performing factor, but you also have large losses. So for example, in the last 2008 financial crisis, momentum had almost half of the returns being wiped out, half the portfolio being wiped out. Okay, so these are measures. They are measures to help. I see some. Sorry, I see some question that, are you able to hear me? Because I have an audience that said that I'm breaking up and I'm silent. Could you all just probably reply in the question box to make sure that you can hear me before I continue? Okay, great. So you guys can hear me. Okay, so I was talking about the momentum have issues, all right, when the market turns, especially in the 2009 financial crisis, 2008 financial crisis, and 2009 was a rebound, right? It was a very fierce rebound if you remember. So momentum had very big issue when it comes to rebounding. Okay, actually it wasn't on the crash part, it was on the rebound part that momentum lost a lot of money in the last crisis. Okay, so one of the mitigating measures that you can use to dampen the losses was to uh, use multiple factors, right? So instead of just putting everything in momentum, even though it's like the best performing factor, there's a lot of risks involved, and you do not want to get caught. And that's why putting some money in value, putting some money in size will make you better. Okay, so that's one way. There are also other ways that are being mentioned in the book, which if you want to know more, you can always read it. And lastly, about momentum was that Farmer and French, right, the guys who found value and size have never want to acknowledge momentum as a real factor, because what they found is that uh, momentum worked in every country except one, and that's Japan. All right, and AQR, which is a famous factor-based investing hedge fund based in US, and they explain not that momentum didn't work in Japan, it was suppressed because the value was a lot more overpowering. So if you use a value investing in Japan for the last 10-20 years, you should be doing very well. Okay, and why, if value is overpowering, your momentum loses its excess return, was because momentum and value factors tend to be negatively correlated. So one do well, the other one tends not to do well. So if value has been doing very well in Japan, that would suppress the performance of momentum. So what they are trying to argue is that it's not that momentum don't work, it's that value in Japan was a lot stronger than anywhere else in the world. So let's move on. Okay, so let's move to the last factor, which is profitability and quality. These are pretty much similar. That's why the authors put them together. But I would say that profitability should be a subset of quality, because quality is a lot more encompassing. Right? So profitability are talking about more profits metrics, that like your earnings, like your gross profits, all these are related to profitability. Whereas quality can expand to a return on equity, return on assets, all these kind of things, which may not be profit related. And actually, if you ask me, yeah, quality should encompass profitability in that sense. Okay, so what they did was they ranked the US stock market by gross profitability. Okay, so I won't explain what it is. You can go and research about it, and because we have no time for this. What they did was identify the top 30% stocks by gross profitability, and also the bottom 30% stocks by gross profitability. Then you form the portfolio there. So you have a group of high profitability stocks and a portfolio of low profitability stock, and you long both of them for the same period, and then you compare their performance. So likewise, there's outperformance in high profitability stocks. This is a lot more intuitive for everybody, right? You want to buy higher quality stocks, it should give you higher returns. So the difference is about 3.1% per year if you buy higher profitability stocks versus low profitability stocks. So what I learned about profitability, right? One of the key things was about this accrual anomaly. Okay, so accounting system is accrual in the sense that let's say you have $1 earning, right? Okay, $1 of earnings per share. This $1, one whole dollar, like, may not be cash. Okay, may not be all cash. So there is a cash component, and then there's a non-cash component. All right. So the non-cash component is known as the accrual. Okay, this is accrual. So what they're trying to say, right, if your earnings is predominantly non-cash, all right, you will end up with an accrual anomaly that even if your earnings is high, but most of them are non-cash, your future returns from this stock is going to be terrible. Okay, so it is not about the earnings, but a lot more about the amount of cash that a company generates. So that is something that we should keep in mind when you use a profitability factor exposure, make sure you do check for the cash element in terms of the earnings that you are looking at to express some of these metrics to make sure that you don't fall into this accrual anomaly issue. Okay. So chapter 9, if you ask me, should be the most important chapter of the entire book, because I have always wanted to find out the outperformance of a multi-factor portfolio, because we talk about, oh, there are so many factors there, right? What if we combine them into a diversified portfolio? We used to know that by modern portfolio theory, right, you should have some stocks, you should have some bonds, you should have some cash in your portfolio, right? So it's by asset allocation. Okay, so it's essentially it's asset allocation. But if you ask me now, with all this new research, why not you diversify by factors, right? So you have factors that gives you outperformance, but you don't know who perform well in different periods, right? Because if you can know, then definitely you want to concentrate your portfolio in a particular factor, but we do not know which factor will perform well before it happens. So having a diversified multi-factor portfolio will give us high return, and by diversifying them would lower our risk in that sense, right? So that was what I wanted to find out, and the authors did me a good service to dedicate a whole chapter on implementing a multi-factor portfolio. So that gives me leads me to talk about the second most important table. Okay, later I'll share with you the most important table. This is the second most important table, where you can see the author put together the different various factors, okay, in this table, right? So and so. Okay, so they tell you the odds of outperformance. You can see that no one strategy, right, or no one factor is able to give you 100% guaranteed outperformance in the first year, 3 years, or even 5 years. Okay, some have varying, some reaches the 100% mark, like momentum. Okay, so if you have done a momentum factor over 20 years, right, you are sure that you will make money. Okay, you'll sure have not just make money, you outperform the market itself. Okay, so some reaches the 90% mark earlier, okay, some a lot later. All right, so it is a good table to help you summarize and set expectation right. And there's no one factor that works all the time, and you must be careful and not have unrealistic expectation. And when the reality falls short of it, right, you tend to give up a lot sooner than you actually should be doing. Okay. And in terms of this Sharpe ratio, right, what it's trying to tell you is that the higher the better, the risk-adjusted returns are better. Okay, so this is how it's being played out. But I would warn you about this. You can see the Sharpe ratio for momentum is the highest. Okay, the issue is when the Sharpe ratio for momentum is not a true reflection, because remember we talked about there's a large crashes for momentum. When market rebound very strongly after a market crash, momentum tends to do very, very poorly. So this is not a reflection of the degree of drop during those periods. So this is a more moderate over a long period of time. It has a higher Sharpe ratio, but it is actually quite a difficult factor to tackle out of so many factors that we've discussed. Now, the most important table, okay, what you should focus on is now into this P1, P2, and P3. Okay, so what is P1, P2, and P3, right? So it's the multi-factor portfolio. So P1 consists of beta, size, value, and momentum. P2 has everything plus quality. P3 have everything except that replace quality profitability. Okay, so what is interesting is that look at the number of years it takes, right, to give you 100% chance of outperformance, or what you want to see a 0% underperformance as soon as possible. And you can see if you run a single factor strategy, right, you will take a much longer time to run to really have a very assured way of beating the market. But if you run a multi-factor portfolio, you have a very good chance, right? I would say after 3 years, right, okay, like P2 and P3 portfolio, right, you're almost quite certain that you will beat the market, okay, with such a low probability of underperformance. Okay, so this means that by combining factors will give you a much more better risk-adjusted returns. So that is the focus that we should be adopting. And if you understand that some of our courses that we run always encourage multi-factor portfolio. So our current portfolio are exposed to size, value, and profitability. Okay, so this is how we can run the portfolio and make returns a lot smoother. And definitely we are looking a lot in momentum, but it's a very tricky animal. It does give a lot of returns, but at the same time we must be careful of momentum crashes. And in the appendices, you will see that they'll explain why dividend is not a factor. Okay, so in fact, investing for dividends alone does not guarantee that you have excess returns. So that's how they say that dividend yield is not predictive of future returns. They have very mixed results, and they couldn't conclude that dividend is a factor. So this has very important implications in your investment strategy. So if you are especially a dividend investor, right, uh, dividend yield might not be the one that you should be looking at. Maybe you should be looking at profitability, and on top of that, layer on a dividend yield as a second consideration, rather than starting on dividend yield alone, because it's very poor predictions of your future returns. And as I mentioned, so dividend stocks tend to appear through factors like value or quality / profitability factor exposures. And dividends is really a very subset of earnings, because $1 earnings, besides giving you dividends, right, there are other ways that the company can reward you as a shareholder when they pay down the debt, or they do share buyback when the shares are undervalued. So there are a lot of other means that they can give you back the returns instead of just giving you in terms of cash. Okay, so probably that is why dividend yield alone is not a good factor, or not even considered as a factor. And something that they didn't put in the main book was this low volatility. And they, because of the very close similarity, right, they tackle this topic together with low beta. But in the strictest sense, low volatility does not mean it's low beta. Okay, the technical details we will not go through here, but just understand that it's not technically the same. They are largely similar, but there are some parts that are not the same. So for simplicity's sake, we'll just put them together. So it has been explained in the appendix why they did not include in the main book, because they said that returns actually came more from shorting high volatility stock than to long low volatility stocks. Unlike the rest of factors, right, all the returns are all generated from the long side rather than the short side. So they're saying that most of returns for low volatility factor comes from shorting rather than the buy side. Okay, so they did not want to include that. And second is that they also mentioned there are some risks at this point in time, because low volatility stocks are like bonds, right? And now currently the interest rate is very low, the chances of going up is very high. And if interest rate go up, bond price come down, right? So if low volatility stocks are similar to bonds, rising interest rate might be damaging to these low volatility stocks. And they also mentioned that after the financial crisis in 2008, a lot of ETFs and funds have created this low volatility factor exposure, and it has able to grow quite a large assets under management in these funds. So they also think that this factor is not a good time to put in a portfolio in view of all these scenarios that's been panning out. Okay, so whether you believe that this should be included in the main book or not is subjective, right? But in my point of view, I think they should have put this in the main book rather than in the appendices. And there was some unanswered stuff in the book that I would like them to cover, because not all the factors were covered actually. They also left out this investment factor. Granted that the investment factor is not as strong as the rest of the factors, but it is still a recognized one, especially Pharma and French has put them into their new models. So this investment factor is that companies that continuously reinvest in their businesses tend to do worse in the future. So it's a bit counterintuitive, right? So you actually think that companies who spend to expand their business is a good thing, but essentially that's not the truth, okay, to the research or the data that's trying to show. And I also wanted to see whether there are some other combination of the factors, but the authors only did the P1, P2, and P3, three kinds of multi-factor portfolio. More will be good. At least we can tell how they have performed in the past and roughly get a better sense which factors are a lot more complementary to one another. So in conclusion, this book is a good summary of decades of research, and you can just read so much research in just one book, and most importantly, it's simple to understand. Okay, and if you want to challenge yourself further, you can definitely read the research papers that the book has mentioned, because they are just quoting papers from papers to papers, right? If you want to get a full pictures how the study is being done, and you can definitely look at the bibliography, you are able to find those papers. Okay, and of course, the authors have definitely added in their own worldview towards factor-based investing. They may not be right with everything, right? So it is good to ponder and to read a bit wider in this subject to gain a much more balanced view on this factor-based investing. But if you ask me, I think if you are interested definitely in a more quantitative way of investing, this is a book to be read. Buy it, keep it, and reread it from time to time, because it's almost like a textbook that you can use for a long time. Okay, so now I'll move on to questions. I can see you guys have posted quite a number of them. All right. So Lester is asking, okay, if the studies by Pharma and French are based on US stock, isn't there a bias? If so, how relevant is factor-based investing to Singapore stocks? Okay, to clarify, right, Pharma and French did not just do US, they did for the whole world. Okay, and what I mentioned about the US was the authors of this book, okay, Swidrow and Birkin, they have done only for the US. Okay, but a lot of the research papers have been done internationally. For example, even the gross profitability, right? Novimarks have specifically done it for Singapore stocks. In fact, they were saying that non-US stocks that has gross profitability factor, right, did much better than it in US. Okay, so remember, one of the 5 criteria for a factor to become a factor is pervasiveness. It must apply to all countries, all sectors in the whole world, and before they are being admitted as a factor. So all these factors that we discussed have passed these criteria, so it's applied to everywhere in the world. Okay. And Clement asks, do you rebalance the portfolio annually? So the answer is yes. All the factors that's being discussed, all the results, the rebalancing is done every year. So for example, if they rank the stock by top 30%, bottom 30%, right? So the types of stocks in that top 30% next year will change, right? So they will follow whatever changes there is to formulate a new portfolio. Okay, so the rebalancing is done every year. So it's not buy and hold for 20 years. So there is an annual rebalancing. So that's a good question to clarify. Okay, and let's also ask about the profitability. If we need companies with good cash earnings, then what's the ratio compared to accrued earnings? All right, so there isn't any specific number, okay, for that ratio. But if you ask me, there are other ways to look at things. Two ways I would tackle this problem. One is probably use quality of earnings. All right, you take operating cash flow divided by earnings, and you want a higher ratio as much as possible. Okay, closer to 1. That will give you a good cash-based kind of earnings. And the second way is what we talk about in our courses. Okay, we use like free cash flow. So if your free cash flow yield is generally quite high, close to your earnings yield, or is more than enough to cover your dividends, it gives you a good assurance that the company is earning cash rather than just pure accrual earnings. All right, and Lester again, so he asked about low volatility stocks. Are the author saying that we should give it a miss, right? Yes, the authors actually suggested that, but I think that low volatility is still a valid factor, and probably is better to be combined with other factors. So for example, maybe we can combine value with low volatility or quality with low volatility. Okay, so these are some of the ways that I think it is still a valid factor. In this sense, I kind of differ from the author's preference. Okay, Ken, feel free to ask if you have any more question. I can probably take one more. Anyone? Okay, if not, thank you for listening. I hope that this is a good summary of the book. There are a lot of nuggets of wisdom that's there. So who knows, right? Because I also using my worldview to summarize this book, and I share with you what I've learned. There might be some things that I would think that there are a lot of things that probably they are written in the book that you would probably find refreshing, and some new knowledge that you might pick up from there. So I hope that you should give the book a read. Okay, and let's see what's the next webinar. If we find anything interesting, we might just share with you again. So do stay with us. All right, thank you for listening. All right, good night, guys.